Hello and welcome to this webinar. My name is Antipas Asfor and I'm part of the portfolio management team that discretionarily manages client funds. This webinar is aimed at those of you who are not really familiar with intermarket analysis. Intermarket analysis may sound like something advanced for many of you. What I want to show you, however, over the next 30 minutes is that this is not the case. Not only is intermarket analysis straightforward to grasp, it can provide an investor with early alerts as it combines fundamentals with technicals and economics, thus ultimately helping improve your performance. But why do we care about improving your performance? Well, unlike the vast majority of online forex companies, we are not a market maker. We operate an agency model and hence we do not profit from your forex losses. Therefore, we are incentivized to help you by building the necessary tools and educating you to become serious and successful traders. Before we begin, please take a note of the disclaimer. What it essentially says is that what we'll discuss in this webinar should not be seen as investment advice. So I'm not telling you whether to buy or sell any currencies or securities. The reason why we're holding these webinars is for you to learn through our interaction. So make sure you get involved. During the event, if you have a question, please ask in the Q&A window. During the webinar, please keep your questions related to the content I've presented so that we can maintain the flow and keep on topic. I will stop at various points along the way and address any questions, giving you also the chance to ask any final questions at the end. All questions posted in the Q&A will only be seen by me. This webinar is being recorded, but please note that I won't refer to anyone by name and I will answer your questions anonymously. Now in this webinar, you'll become familiarized with the business cycle. You'll learn the different relationships between asset classes such as equities, bonds and commodities. And we'll see both in an inflationary and deflationary environment what these relationships are. We'll see when different sectors perform well, and you'll be introduced to the concept of relative strength. Before we get started, it pays off to get our definition straight so that we are all on the same page. Intermarket analysis is the study of the relationships between different asset classes. Focus is on the correlations between fixed income, equities, commodities, and currencies, i.e. how they move together, how they move over the same time period. Now here we see the idealized business cycle in an inflationary environment. Stage 1 shows the economy contracting and bonds moving upwards as interest rates decline on loosened monetary policy. So loosened monetary policy, for instance, may be a form of quantitative easing or lowered interest rates. The lowered interest rates help bonds increase in value. Stage 2 now is the bottom in the economy and the stock market. Although economic conditions have stopped from getting worse, the economy is still stagnant. However, investors anticipating an expansion lead the stocks to bottom before the contraction period ends. Stage 3 shows significantly improved economic conditions as the business cycle prepares to move into expansionary territory. Expansionary territory is this threshold line here. So above this line, we're essentially in positive growth, and below this line, the economy isn't in expansionary, it's in contractionary territory. Now, stocks have been rising and commodities now start doing well as prices rise. So a lot of commodities being purchased as a hedge against inflation. Stage 4 marks a period of full expansion. Both stocks and commodity prices are on the rise, but bonds start turning lower because the expansion increases inflationary pressures, which prompts interest rate hikes. Stage 5 marks a peak in the economic and the market cycles. Even though the expansion continues, the economy grows at a slower pace because rising interest rates and rising commodity prices impact inflation and consequently consumption. So you consume less because prices have increased. Stocks anticipate a contraction phase by peaking before the end of the economic expansion. Commodities, though, remain strong and peak after stocks, being held as a hedge against inflation. Stage 6 now shows a deterioration in the economy as the business cycle prepares to move from an expansion phase to a contraction phase. Stocks have already been trending lower and commodities now start turning bearish in anticipation of decreased demand from the slowing economy. Keep in mind that this is the idealized business cycle in an inflationary environment, with bond and stock prices moving together in stages 2 and 3. So we've got the bonds moving higher and the stocks moving higher. What happens in a deflationary environment when bonds and stocks move in opposite directions, we shall see later on. So we've got an inflationary environment, bonds and stock prices being directly related. Fixed income prices tend to be a leading indicator of stock prices rising ahead of stocks. Fixed income prices move inversely to fixed income yields. So when you have falling bond yields, you have increasing bond prices. Now, loose monetary policy, such as lowered interest rates or quantitative easing, cause these yields to fall and fixed income prices to rise. And equity markets may benefit in such an environment, as has been the case in the years following the 2008 financial crisis, with very loose monetary policy, record low interest rates, and quantitative easing triggering a boom in equities. Tight monetary policy, i.e. increasing interest rates, causes yields to rise and fixed income prices to fall. And this is usually negative for the equity prices. Now here we see the intermarket relationship between the S&P 500 and the 10-year Treasury note yield. Remember that there's an inverse relationship between bond yields and bond prices. Falling bond yields means increasing bond prices. So the falling yields we see here translates to higher prices. Now the bond has its axis on the right hand side, as we can see here, and the S&P on the left hand side. So falling bond yields mean increasing bond prices, and we can see that as bond prices are increasing, so is the stock market. Now this relationship, as we said, holds in an inflationary environment, which is what we were in until around 1998, with the aftermath of the financial crisis leading to the decoupling of this relationship. Okay, I'm getting a few questions whether or not we'll be covering how the bond market affects Forex. We'll be looking at the intermarket relationship between the US dollar and commodities, for instance, and as well as some other of the asset classes. We'll be covering now bonds and commodities, which is another intermarket relationship. And it's an inverse relationship between bonds and commodities, and this tends to hold in both inflationary and deflationary environments. Commodity prices tend to be a leading indicator of inflation, so we see commodity prices rise ahead of inflation. Loose monetary policy, which, as we said, is lowered interest rates by central banks, and quantitative easing cause yields to fall and fixed income prices to rise. The prices of commodities tend to rise as inflation rises and the economy expands. Tight monetary policy, which is increasing interest rates, causes yields to rise and fixed income prices to fall. and the tightening that's taking place to control inflation impacts commodity prices, which subsequently see declines. Now that we've seen the relationships between the different asset classes, it is time to put the US dollar in the picture. The US dollar and commodities are inversely related. The reasons are that many commodities have their value denominated in US dollars. Moreover, commodities are often used as a hedge against inflation. So an appreciating US dollar, on the other hand, is considered non-inflationary. Loose monetary policy, lowered interest rates, QE by central banks, makes the dollar less appealing. And this gives rise to investments in gold, which tend to increase when the US dollar depreciates. And this was the case following the initiation of quantitative easing programs by central banks. In the aftermath of the 2008 financial crisis, we saw gold rise following the crisis to record levels. Tight monetary policy makes the US dollar more attractive, and gold tends to depreciate in such an environment, and this to some degree is what we're seeing over the past 6 months or so, when anticipation of the first Fed rate hike has seen the dollar move higher, placing pressure on commodities. Now here we can see the inverse relationship with the US dollar tending to move lower when commodity prices move higher. So we've got the dollar index in this goldish line, and commodity index in this white line. And we can see, since middle of 2014, the dollar index rallying, the dollar surging, and commodity prices plunging. And this was also evident in an opposite manner following the 2008 financial crisis. During the 2000 financial crisis, we had the dollar index soaring again, and then commodities plunging, and then with quantitative easing going ahead, we basically saw the dollar index moving lower and commodity prices moving higher. Now, this is not a perfect relationship, as you can see, but it does help evaluate the more macroeconomic trends that exist and how these can impact the dollar and the commodities. Now here we are showing something similar, comparing the dollar index to gold and WTI crude oil. Note that the dollar index axis has been inverted. So this is the dollar index axis, and it has been inverted from a low to a high, whereas everything else is from a high to a low. Now this again helps us see the relationships over time. So we can basically see that as the dollar index is moving higher, okay, the green line is the dollar index, DXY, and it's moving higher. So here it was around 80, here it's around 90. As the dollar index was moving higher, we had oil moving lower, as well as gold moving lower. And it was again in the aftermath of the 2008 financial crisis. We basically had the dollar index moving higher, so this move downwards, as we said, is a move higher in the dollar index because this has been inverted. So as the dollar was moving higher, this yellow line, which is crude WTI, was moving lower, and so was the case with gold. I'm getting a few questions about crude and the reasons why it's moving lower. There are a number of factors that interplay. Yes, production, of course, is important, but you should also note that because of the strengthening dollar, Commodities generally see some weakening when the US dollar is strengthening. Now that we have seen when different asset classes perform well, let us shift our attention to sectors. The graph shows the economic cycle in orange. Okay, so here's our key, and in blue we see the stock market cycle, so the market cycle. The orange cycle, the orange economic cycle, is the same as the cycle with the 6 stages we saw before. The center line, which is this line here, denotes the contraction and expansion threshold for the economy. As we mentioned before, the stock market cycle leads the business cycle. So the market, the blue line, turns up, or we can see it from here, from the bottom. The market turns up before the economic cycle does. Similarly, it contracts prior to the economic cycle. So we can see here that it starts contracting prior to the economic cycle. Cyclicals, or the consumer discretionary sector, are the first to turn up from a bottom. So we've got the cyclicals here, and they're the first to move upwards from a bottom in the economy. Technology then follows. So you can see that this is a wave. So once we start moving higher, we've got consumer cyclicals which start outperforming at the bottom, and then technology. These two groups are the big leaders at the beginning of a bull run in the stock market. The top of the market cycle is marked by relative strength in materials and energy. So the energy and materials, they tend to do better than some of the other sectors. These sectors benefit from rising commodity prices and demand as the economy expands. So this is why they're peaking, and they're essentially lagging in their move higher. As the commodity prices move higher, then these benefit. And as we saw in one of the earlier slides, the commodities advance after stocks have advanced. So it's bonds that move first, and then it's stocks that move higher, and then it's commodities which start moving higher in anticipation of an inflationary environment. The turning point for the market comes when the consumer staples outperform the energy sector, indicating that commodity prices are starting to hurt the economy. The market peak and downturn are followed by a shrinking of the economy, with central banks lowering interest rates and the yield curve steepening, i.e. the front-end rates, the shorter-term rates, move significantly lower relative to back-end ones. Following interest rates benefit utilities, which are highly leveraged with lots of loans, and banks, who can conduct more business, as the steepening yield curve also improves their profitability and encourages lending. Low interest rates and easily available money eventually lead to a market bottom, and then the cycle repeats itself. Yes, the blue is the stock market. It's the market cycle. The orange line is the economic cycle. So it's basically things that have to do with the economic indicators coming out of a country, basically, its growth, etc. Now, some of you are probably wondering, how can we know when, in which stage of the economic cycle we are? Well, this table can help us if seen as a possible guide. Consumer expectations in a recession are reviving. In an early recovery, they start to rise, and when we're full on recovery, they start to decline. And when we have the start of a recession, that's when they fall sharply. I'm sure some of you can associate this with what happened in following the 2008 financial crisis and thereafter the recovery. Industrial production bottoms in the recession, starts to rise in an early recovery, and somewhat flattens well on in the recovery. And early in the recession, you basically begin to see falling industrial production. Interest rates during a recession fall in order to make lending easier, in order for the economy to try to expand. They bottom during an early recovery, and then they start to rise during the recovery phase, peaking early in the recession. So you can see here how central banks relate to the cycle stage. Their decisions for interest rates to a great degree impact the stage of the cycle. We saw that following the just before the 2008 financial crisis, we're seeing increasing interest rates by central banks, such as the Fed, for instance. There were early signs of a recession taking place from 2007. We had interest rates rising, and thereafter we had falling interest rates, record low. They bottomed, and now it's the discussion as to when interest rates will start rising again from their record lows, indicating a possible recovery stage we're in. Yield curves are normal in a recession. They steepen early in the recovery. They start to flatten well into the recovery, and they become inverted. So the yield curves relative to the bonds become inverted early in the recession. What we covered previously was relationships in a deflationary environment. Since 1997, since the Asian financial crisis, bond and stock prices move in opposite directions. We're seeing more of a deflationary environment. Disinflation, which is falling inflation, is good for both fixed income and equity investments, whereas deflation is bad for equities and commodities. The inflationary environment caused funds to move to fixed income investments and interest rate sensitive sectors such as utilities, moving away from the stock market. And this was very evident in Japan, for instance, following the financial crisis there. But this has been prevalent across the globe, as there is not as much inflationary pressures as there were in the past, which is good for the bond investments. Here we can see the relationship. This is a continuation of the previous chart we saw with the S&P 500 and the 10-year T-note, and we can see how the relationship has changed with the relationship becoming inverted. So the US 10-year yields are shown in red with the axis on the right. So we can see that the yield is moving lower. So that means that the bond prices are moving higher. And we can see that the stock market is moving lower at the same period. So the relationship from being a positive one has become a negative one. When the bonds rise, which is the case here, the stock market falls. And this again evident over here with the stock market past few years moving higher, and the bonds moving in this case higher as well. This shows some sign that we're maybe moving towards a more inflationary environment. But this was not the case in previous years, where we would have for instance, move higher in the stock market and move lower in the bond market. The increasing yields signaling falling in the value of bonds. Now I'd like to introduce to you another technique in order to assess different sectors or different markets. It's the relative strength analysis. This is different from the relative strength index, the RSI, which you may be familiar with. Relative strength analysis is simply creating a ratio line by dividing one market or sector with another. So it's a simple division. The rising ratio line favors the dividend, which is the market at the top, and the falling ratio line favors the divisor, which is at the bottom of the equation. And the aim is to find the market or the sector which is relatively overperforming. Doesn't necessarily mean that it'll make you money, it just means that the one is performing better relative to the other. And with these and with this analysis, you can carry out trend line analysis as you would do in your charts with technical analysis, and it also can be used to identify divergence with the market under study. So here we see the consumer discretionary and staples ratio. So we've divided the consumer discretionary by the staples, and we're comparing it to the S&P 500. The S&P 500 is the blue line with its axis on the left, and the consumer discretionary and staples ratio is the red line with the axis on the right. So we can see here that when the staples started to do better than the consumer discretionary, when we saw an end to this up move, this could signal a possible warning that the market may be peaking, and indeed the ratio peaked before the market did, and it moved lower before the market did. And also saw in around 2009, end of 2008, 2009, the consumer discretionary staples ratio starting to move higher before the market bottomed, and this was a positive sign that the market may be starting to move higher, because as we mentioned, the consumer discretionary sector is the one that does well, starts doing well at the market bottom, whereas the staples start moving higher as the market begins to contract. So when you've got the consumer discretionary moving higher in an uptrend, you're basically seeing a possible bottom in the market, or it may be used to hint to a possible bottom in the market. And besides this, you can employ trend line analysis. So for instance, you could have drawn a trend line round about here to serve as a warning. The trend line would match the move in the market, in the S&P 500, or for instance over here, you could have drawn a trend line on the ratio, on the relative strength between the consumer discretionary and the staples ratio. Another interesting point to note is that around October, we saw that consumer discretionary staples ratio failed to make a new high, whereas the stock market, the S&P 500, did make a new high, and this hints to a possible divergence. For those of you who are accustomed with the concept from technical analysis, and this was followed by that steep decline we saw in the equities. And one may say that again we may be seeing a possible divergence over here with the S&P 500 rebounding, but with still some caution in the ratio between the consumer discretionary and the staples ratio. So you can see that there's some movement towards more defensive side investments. Now, by now, you should know the various stages of the business cycle, being able to identify which asset classes are likely to overperform. You'll be familiarized with sector rotation analysis, understanding why sectors may perform differently under the same market conditions. And you'll recognize the benefit of employing relative strength analysis in order to complement our other analyses. Now that you've embarked on this journey to intermarket analysis, it is important to get further involved. You may look to read more on the topic, with the works of John Murphy and Martin Pring being a good resource. You may look to advance your knowledge in trading in general by following some of our other webinars, and you may experience and practice by opening a demo account. Experience is the best tutor, so you may want to download our MT4 platform and run a demo account, putting into practice the various analytical techniques we discussed. For those interested in viewing a webinar, another webinar, you probably know where to go. Under Tools, you'd click on FxPro Webinars, and you'd see the next webinars in line. So we can see that the next one is the outlook for FX fundamentals, and thereafter charting analysis. As I said, I would be more than happy to take any questions you might have. The whole purpose is for you to become acquainted with this concept. I'll start going through some of the questions which were left behind as to which stage we are in the current environment. Okay, let's move backwards to facilitate this. Basically, what we're seeing in this current environment is discussions about interest rates moving higher. So this leads us to an early conclusion that we're in a recovery phase. If we review some of the other things, we can see that consumer expectations, depending on the region, are different, and that is also the case in industrial production. So the cycle stage analysis you carry out shouldn't be done for a global level. I mean, it's useful to try and figure out where the global economy is going, but when it comes to investing in individual markets, you'd want to assess how that particular market is going, besides the global environment. And what we're seeing is a divergence between what is taking place in the US and what is taking place in the Eurozone, for instance. A few months ago, the ECB, the European Central Bank, decreased its interest rates. This is a sign that takes place during a recession, as we can see here. Obviously, it's not in the phase it was following the financial crisis or back in 2011, but it does give you a divergence that exists between what's taking place in the Eurozone and what's taking place in the US, where the discussions are not about falling interest rates, but they're about rising interest rates following the end of the quantitative easing program. And you also have, for instance, Japan, which expanded its quantitative easing program a few months ago, which again shows a divergence between what's taking place in the US with what's taking place in the Eurozone. So the cycle stage depends on the market, and these do help as a guide, but obviously this is no panacea. Okay, regarding the US dollar relationship and how this impacts, so a number of you are interested in the Forex implications. Okay, for those of you trading the dollar, and especially for those of you who are also trading, some commodities or precious metals, it's important to note that generally commodities are denominated in US dollars. So when you have a strengthening dollar, that would apply some downward pressure on the prices of the commodities. And obviously this relationship isn't perfect. There are many other things that influence the different markets and the price movements, but you can see that in a strengthening dollar environment, as we've seen in the past 7-8 months, the commodities have indeed seen a significant down move. So you'd want to limit your exposure, especially if you're an investor and you're, for instance, heavily long on different commodities which are denominated in US dollars. For those of you asking about the slides, the webinar will become available on our YouTube channel over the next week or two. So be posted to view our webinars there. So let me just show you where you can go for this. So you can click here to go to the YouTube channel, and you can see all our webinars over here, webinars recorded. So different webinars for you to possibly watch at your own convenience. Okay, regarding the inflationary and the deflationary environment, deflationary environment doesn't necessarily mean that prices are falling. So let me just move to that slide so we're all on the same page. Yeah, a deflationary environment doesn't necessarily mean that prices are falling. It just means that there's less pressure, less price pressure. The impact of prices is not as big as an inflationary environment. And this has been the case over the past 15 years or so, where inflation has been at very low levels across different countries. Okay, let me move to the final slide. If you've got any final questions, now's the time to ask them. What I want to say is, if you get stuck on anything, please email us at support@fxpro.com. When you're trying to set up a demo, open an account, or wherever, or contact us by live chat from our website. We'd be more than happy to hear any webinar ideas you may have at webinar@fxpro.com. I'm Antipas Asfor, Portfolio Management Officer here at FxPro. Thank you all for watching.